It's interesting how many questions I've been asked on this recently. A lot of things haven't changed very much on disclosures in relation to directors' current accounts for a long time. Of course, FRS 1021A did rather shake things up. Yet people are questioning the sort of received wisdom of how we disclose these things. So I think it'd be useful to do a session on revision. Now, in the notes, it starts off by saying many companies have directors' current accounts in operation. Well spotted, they do, don't they? Very many small companies, particularly owner-managed companies, run with the director's current account. And this director's current account is sometimes overdrawn. I nearly said often overdrawn, but it is fairly frequent for it to be overdrawn. That is where the company has effectively lent the director money. Now, before we look at the disclosures in relation to that, let's think about the legalities. You know, it doesn't seem that long to me ago that loans to directors were just illegal. I mean, this was only 2006 and before, and it didn't matter whether you were a private company, all loans to directors were illegal, and that was that. Although it is worth just repeating that the fact that these loans were illegal did not slow people down even a little bit from making them. The way it works now is that loans to directors are still illegal, except small loans, minimal loans of £10,000 or less are not illegal. Loans above can only be made legally if there is the approval of the members. Now, the way this works is that when advances are being made to directors up to £10,000, it is all legal. It becomes illegal when it just goes over in aggregate. So imagine an overdrawn loan account that is up to £9,999. All legal, doesn't need members' approval. Maybe that director one morning when they're filling up their car with petrol, they just buy a cheese sandwich from Tesco's for £2 on the company credit card. And it is that would tip it over into being illegal. So a £2 loan, effectively, could make it illegal if you're already up to £9,999. Members' approval, the legislation doesn't particularly talk about that mechanism, but you'd have thought that some sort of written resolution would be the way to go with members' approval. Members' approval tends to be fairly forthcoming here because that director, as he stands at the counter in Tesco's, might be the only shareholder as well. He could ask himself, am I allowed to make this loan? Yeah, sure, why not? And it's approved. Okay, it's nice to document it to show other people. A lot of people are somewhat surprised at hearing about this need for approval because it just never occurs to them that these things need approving. And I do wonder how often, probably most of the time, people don't get this approval in place and the loans being made are effectively illegal. And I know this probably isn't quite the attitude, but most of the time, who cares? You know, what goes wrong? But some of the time people do care. When a company gets into financial distress, often insolvency practitioners care about illegal loans. Sometimes when a company is sold, reporting accountants care about illegal loans. Every now and again these things do come and bite you, so it is worth to make sure that all the paperwork is in place if there is a loan in excess of £10,000 to a director. Now, do not confuse any of this legality stuff with the disclosure. The disclosure is required for all loans, all advances, credits and guarantees, if I'm to use the precise term. Now, unusually, Section 413 of the Companies Act applies to all companies. So it applies to medium-sized and large, small and micro companies. There aren't many disclosure requirements for micro companies, but this is one of them. So directors or companies have to disclose all advances, credits and guarantees to directors. And Section 413, paragraph 3, a severe care, requires disclosure in respect of an advance or credit, including its amount, an indication of the interest rate, its main conditions, and any amounts repaid. If I'm being picky, a more recent change to the legislation did add amounts written off and amounts waived, not that they're terribly common disclosures that you see. Another thing just worth pointing out and reminding you of, this disclosure is in respect of an advance or credit? I'll talk about this more. It's very tricky. The Companies Act doesn't appear to be thinking about aggregation. They're looking for disclosure on the basis of, on an advance by advance basis. Now, advances and credits, this is the disclosure requirement. The disclosures for guarantees is a little bit different. Actually, while I think of it, the legality on guarantees is different as well. Guarantees of directors' borrowings are legal up to $50,000, and then they need approving. So in terms of guarantees, the disclosure requirements are you disclose the main terms, the amount of the maximum liability that might be incurred, and any amount paid and any liability incurred by the company in actually settling the guarantee. So different disclosures, because guarantees are different things to advances and credits. Now let's focus on the advances and credits, because they're the more common transaction, and let's just do a quick, easy little example of what the disclosure might look like. So in this example, simple. I've got a company that just makes a single loan, a single advance to a director, one transaction. We would disclose that during the period the company made a short-term loan to a director amounting to £50,000. Note, we have to disclose the amount. We don't have to disclose the purpose, so the next bit's a bit superfluous for the purpose of a house purchase, but we do need to disclose the interest rate. Interest at the rate of 4.5% per annum is payable. That's disclosable. It's payable half-yearly, and the loan is repayable on the 31st December 2020. Both of those things are disclosable as well because they are the terms of the loan. So notice the disclosure requirements are pretty onerous. Now, what most of you will have noticed is that just one transaction with the director is relatively unusual. There tend to be numerous advances or credits in the form of a director's current account. It is still the truth that there are directors who treat company bank accounts as if they're their own personal piggy bank and regularly on a daily basis use company credit cards and company checks and company debit cards and company bank transfers all of the time just to constantly take money. Now, when these current accounts are overdrawn, all of that is disclosable, and technically Section 413 requires that to be disclosed on a transaction by transaction basis. But what you will have noticed is that no one ever does that, because it's just, to use the technical term, it's mental. I mean, you have pages of these disclosures for certain directors' current accounts. So, as far back as 2008, the convention arose that you would tend to disclose these in aggregate, taking into account materiality. So, provided all these amounts individually were immaterial, you just aggregate it all together. So, what people tend to disclose is something a little bit like this: opening balance, loans and advances made, and amounts repaid, and the closing balance. Notice that there is no requirement to disclose the opening and closing balance explicitly in the Act, but we do this in order just to give people a good impression of what is going on. So, the user can understand the operation of the current account without necessarily having to see every single transaction. Now, the example here is just an example, and personally, I would probably aggregate this a lot more. I would aggregate all the loans in the period and private expenditure in the period, and I would absolutely aggregate the undrawn remuneration, the dividends, and the amounts repaid, because I really wouldn't want to disclose the undrawn remuneration or the dividends for fear of really disclosing what this individual is earning. Notice at Companies House, these companies, small companies, will not be filing their P&L. So by disclosing remuneration, you're effectively disclosing directors' rem, and by disclosing the dividends, you're effectively disclosing the dividends, the earnings, which obviously are commercially sensitive. And if you're disclosing the dividends in aggregate, you're also effectively disclosing the profit, because if you know the extent of the dividends, the opening balance, closing balance, you don't have to be an accounting genius to work out the difference. So this is why we aggregate these things. It's a convention, really, to get round having to individually disclose every transaction. That's debit balances. Life gets more complicated. What do we disclose with credit balances? That is when there is a director who is owed money by the company rather than owing money to the company. Well, Section 413 has no application at all for this. 413 is loans, credits and advances to directors. It's not from. So you're never going to get Section 413 disclosure for credit balances. So for micro companies, nothing. Thing is, credits, loans from directors are still related party transactions, and for medium-sized and large companies, I would have thought that you're always going to see those disclosures in all circumstances, if they're material, that is, because there's no let-out to it. Small companies are more difficult because in small companies, yes, you do have to disclose transactions with directors, but you only have to disclose transactions that aren't concluded under normal market conditions. So if these credits are all under normal market conditions, there absolutely isn't any disclosure. But the fact is that these credits normally are interest-free. So when a director lends the money to the company, they don't charge interest. Personally, my view is that clearly is below market condition, below market terms, and I think you need to disclose these things. I happen to think that these disclosures aren't particularly commercially sensitive, so I'm a little bit happier with the whole, disclose just in case. But I do believe that when companies borrow money from people who aren't directors, they tend to pay interest. Therefore, a director not charging interest, it's not concluded under normal market conditions, therefore it is disclosable. Obviously, life does get quite complicated when a director's current account fluctuates during the period between being a debit and a credit balance. Strictly under 413, you have to just disclose the debit balances, but I think a lot of people do aggregate it just to make life easier. Let's look at another complication here. What about a director who resigns partway through the accounting period? You know what? What about a director who's appointed partway through an accounting period? What do you do with your 413 disclosures there? Well, 413 requires the disclosure for the full accounting period for anybody who was a director at any time during the period. This means that if a director for a December 2018 year end were to resign on the 1st of January, they will need to include disclosures for the full accounting period, even though they might have been a director for just 9 hours. Tough. Equally, if a director was appointed at 10 minutes to 12 on New Year's Eve for a 31st December 18 year end, their director's advances, credits and guarantees would need disclosing for the full period. Getting appointed a director at 10 to 12 on New Year's Eve, well, there's a fun New Year's Eve party just there. Let's look at another angle on this, though. Again, the notes astutely identify that very often a company will make a loan to a director, and this loan can either be at below market rate or interest-free. Don't forget about the need to discount these things. Notice that where there is a loan to a director, there are no exemptions that apply to that for small companies not to discount it. When the loan is the other direction, there are exemptions. Now, within the notes, there are some examples here of how things work, but most of these loans are repayable on demand, aren't they? And if the loan is repayable on demand, you don't discount it. So if there is a loan to a director at below market rate or interest free, I think in reality you very rarely would see it discounted. Of course, if the loan is going the other way, and again, it's repayable on demand, discounting is a non-issue. If there is a loan from a director shareholder to the company, then you can use the exemption. That is in the small company standard. Now, within the notes, there are a number of examples in this area, but my personal experience is that 999 times out of 1,000, these loans are repayable on demand, and no discounting is needed. I have hardly ever come across anybody who uses the small company exemption. Very, very rare. But if you do, of course, there is the issue that when you go from being a small company to medium-sized and large, you lose the exemption. And of course, you need to deal with the transition when you lose the exemption. And actually, in the accompanying notes to this session, there is an example of how you deal with that transition. Now, I'm not going to go with it through it here, because I think the circumstances are so unusual that perhaps no one's going to be interested in it. But I would point out that there are some examples in the notes on how that works. But primarily this session is about reminding you of section 413 and how we deal with the sort of aggregation problem and how we disclose it. And I hope that was a useful recap for you. Thank you.